Good afternoon. This is Frank Barradin with Miller Johnson, and this is going to be the monthly employee benefits lunch break webinar series for May. And I'm going to talk to you today about Secure Act 2.0 update. And you should certainly expect that the November 15th webinar will be on this topic as well, because by then we will likely have a lot more guidance than we have now. Certainly, as far as providing input to us, we did get a few questions ahead of this, and so I'm definitely going to cover those. And so it's very helpful if you have specific questions to let us know ahead of time. If things come up during the presentation, I may be able to address them, but it's very helpful to have them ahead of time and certainly to get feedback after the seminar is done. So let's get into the material today on the Secure 2.0 Act update. I've kind of got good news and bad news, and that is that the good news is the same as the bad news, which is we have had zero additional guidance issued by IRS, Department of Labor, any changes in Congress that have to fix any of the technical problems that people have pointed out regarding Secure 2.0 Act. So that's kind of the good news. There's not a whole lot that you have to focus on here that is new. And it's also the bad news, because we have a lot of questions that are unanswered and we can't really start fully preparing for the changes, at least, that become effective in 2024 and later. So that's the challenge right now of figuring out what to do about all these new rules. So what I'm going to do, and I thought would make the most sense today, is cover basically 4 topics. And this should be quite a bit shorter than the presentation we gave in January, where we kind of went through all of the different changes made by the Secure 2.0 Act. Now I'm going to focus just on the rules that are effective in 2023, the eligibility rule changes that are occurring in 2024, the catch-up contribution rule change for 2024, and the impact of these rule changes specifically on governmental employers. And I put the governmental employer piece last, figuring that the majority of the people listening are likely not governmental employers. So at that point, if they are not interested, they can drop off. But that will be fairly short at the end anyways. And actually, this entire presentation will likely be very short, because I'm not going to rehash everything that we talked about in January. I will go over some of those things again, but mostly I just want to point out things that we have been thinking about as a result of digesting all of these new rules, and things that you can't wait until November to start preparing for. Really, there needs to be some discussion going on now about these changes in 2024, and certainly the things that are in effect right now. And we've kind of come to some decisions on at least how we believe it's best to comply with those things for the interim until we get additional guidance, which obviously there is a whole lot of additional guidance that's needed here. To go back a little bit, Secure Act 2.0 was signed into law on December 29th, 2022. And whenever they do these kinds of bills at the end of the year and they rush to get them passed, you end up with legislation that has a lot of either technical problems or issues that have not been fully thought through. And so we have some of that with this legislation. The good news about this is that the deadline for amending plans isn't until the end of the first plan year, beginning on after January 1, 2025. And government and union plans have 2 more years. So the amendment deadline is pretty far off. Once again, that's kind of good and bad. I mean, we're in this situation where we haven't had to do amendments yet for Secure 1.0 or the CARES Act, and those will now be also due by the end of 2025. So, but you've been required to operate in compliance with those laws, as well as Secure 2.0 for several years before you have to actually do the amendment. So the challenge, of course, is by the time you get around to doing the amendment, do you remember what things you implemented and when you implemented them to make sure that the amendment accurately reflects how you've been administering the plan? And that's, of course, a critical thing in an audit. I have some clients that are going through some IRS audits right now, certainly Department of Labor audits, the same thing. It's not good enough to just tell them that you've been in compliance with the law. You have to show them that you're in compliance with the terms of your plan document, and that also has to be in compliance with the law. So it's very important to make sure that your document reflects what you've actually been doing. Okay, so we'll start with the changes that are currently in effect in 2023. And one of the significant ones is what happens when you have errors in your plan and you're trying to correct them. And one of the changes that was made relates to recovering overpayments. And there are some good changes here, is that generally employers are free to not recover them in most cases, unless there's a loss to another participant or if a defined benefit plan is underfunded. So the common small overpayment to a participant, it's not really worth it to go after them. And it's even if it was worth it, you really don't want to, you don't have to anymore. And they've made that clear. It also is good that it doesn't affect, these rules don't affect any recovery arrangements that are already in place before the act became effective, or recovering amounts that had been overpaid in the past. If those have already been made arrangements to recover it, you can continue to follow those. But there's some bad provisions here as well, and that is certain overpayments that have been continuing now for more than 3 years, or were first made more than 3 years ago. You discover it now, you can no longer recover that. You can't impose interest or fees on amounts that are of the overpayment. And if the participant is currently receiving payments, so this would be most commonly a defined benefit plan, the recovery has to be spread out over at least 10 years and can't reduce the annual benefit by more than 10%. So that's a severe limitation on recovering in a defined benefit plan where somebody's receiving annuities. You also can't use third-party collection agencies or threaten litigation. And generally, you can't collect from a spouse or beneficiary. Now, this is an area that definitely needs additional guidance, and partly because the last provision here that on the slide is that the limitations on recovery do not apply to culpable participants and beneficiaries. And I've been advising clients for the time being to kind of interpret that word culpable fairly broadly, meaning if it's pretty clear that a participant or beneficiary shouldn't have been receiving the amount that they received, then I believe they're culpable. Unless they asked, they said, look, this doesn't seem right to me. Am I, entitled to this? And somebody responded at the employer and it's documented that they said yes, then they're no longer culpable. But if it's pretty clear that somebody would realize they were not entitled to this, then I think they're culpable. And the most common situation there is when a participant dies and somebody continues to cash checks made payable to that participant. So that may be a spouse or it may be a beneficiary. But I believe in those situations for right now, until we get additional guidance, that you can recover those amounts from that spouse or beneficiary when the payments, should not have been cashed after the participant's death. So that's kind of the situation on overpayments. The second big situation now is self-correction of errors for qualification defects. And the good part of Secure Act 2.0 is that it broadens significantly what should be available for self-correction. Any eligible inadvertent failure should now be eligible for self-correction if it's made before the IRS discovers the error. So you correct it before the IRS audit. Failure is corrected within a reasonable time after the discovery. failure is not egregious, and the failure is not an abusive tax avoidance transaction. So this is very common. I mean, it's so common with all these complicated rules, with all the challenges of complying. There are many, many errors that occur. And of course, currently we have the self-correction program as part of the EPCRS that also includes voluntary correction, where you go to the IRS and you request approval. But this should hopefully allow far more errors to be self-corrected. What the biggest challenge with this is that the IRS has been given direction to update its guidance on EPCRS, and that's required by the end of 2024. So we don't know at this point how broadly the IRS is going to interpret this. My advice for now is to interpret it fairly broadly. And if you find a defect, self-correct it, document that you've self-corrected it. And then if the guidance turns out when the IRS issues it sometime in the next year and a half to be unfavorable, at that time, you can still file a VCP and get approval from the IRS. But in the interim, unless there's a strong reason to file a VCP, like the dollar amount is potentially, very large, and it's very risky to even wait, because obviously if an audit occurs in the interim, you would not necessarily be protected. So if there's some doubt, you may still want to file a VCP. But in general, a lot of situations I'm running into, I'm saying, all right, let's get this self-corrected in a way that we think is totally reasonable and appropriate, not file with a VCP with the IRS at this time. And if the guidance comes out later that says we really need to file, then we will at that time. Another change that obviously is effective in 2023 is the change to the required beginning date, which now it's become 73. Fairly soon, it will become 75. These changes are probably, pretty simple. The bigger changes have probably been in the post-death minimum required distribution requirements. And those were part of Secure 1.0 Act, and those generally required distributions after death to be paid more quickly now, not necessarily spread out over the beneficiary's life expectancy, but generally having no more than 10 years that they have to be paid out. So those rules are currently in effect and are part of Secure 1.0. Secure 2.0 has added the change of from age 72 to 73. It's also reduced the excise tax for failing to take timely required minimum distributions from 50% to 25%. That's already effective. Of course, in many cases, if you have a missed required minimum distribution, you may be better off filing under VCP anyways and getting the fee completely waived, or potentially the individual can request the waiver on their own personal tax return. So there are other ways of avoiding that, because obviously you always did that in the past. 50% excise tax was so excessive, and 25 still seems like it can be very excessive. Big change that will become next year is the pre-death required minimum distributions are no longer required for Roth retirement accounts, which is similar to what the rules have been on Roth IRAs. You'll no longer have that difference between Roth retirement accounts and 401k. So individuals will not necessarily have to roll their money out of the plan in order to avoid those minimum required distributions beginning next year. So that's a good thing. It's easier to include commercial annuities in defined contribution plans as a result of some required minimum distribution rule changes. And surviving spouses may elect to be treated as the employee for calculation of the required minimum distribution payments beginning next year. So those are the only provisions that are currently effective. And hopefully, you've been complying with those to the extent those things have arisen. But there's a number of things that become effective in 2024, and I'm only going to cover right now the ones that are really significant, or at least you really need to start preparing for them, and not just do it right at the end of this year. And the first one, of course, is the part-time employee rules, which Secure Act 1.0 had one provision that said you basically have to allow participants in after they've completed 3 years with at least 500 hours of service per year. And then Secure 2.0 dropped that to 2 years, but that doesn't become effective in 2025. So the Secure 1.0 Act becomes effective 1/1/24, and that basically says that irrespective of whether you still make participants or employees wait 1 year before becoming eligible for employer contributions, you have to begin allowing them to make their own contributions if they've worked at least 3 years with 500 hours per year as of January 1, 2024. So that's a significant change. And then as of 1/1/2025, that will become 2 years with 500 hours. But once again, this doesn't apply to employer contributions. So what other things did the Congress do that is going to encourage people to allow more of these employees to contribute to the plan? Well, one of the big ones was the top-heavy test can now be run separately for excludable and non-excludable employees. So that means that if you allow those people into the plan and your plan is top-heavy, you will not have to give them a top-heavy contribution, because that portion of the plan, it's highly unlikely would ever be top-heavy. So that is one of the reasons why a lot of smaller employers that have top-heavy plans did not allow employees to start contributing immediately, because they knew they'd have to make an employer contribution for them. So beginning in 2024, you won't have to do that even if your plan is top-heavy. Already in the law is provisions allowing you to run separate ADP and ACP tests. So allowing these employees in the plan, which of course you're going to be required to do in many cases, you can run those tests separately, and therefore allowing them in, even if they don't contribute or they contribute at a very low level, won't cause you to fail the ADP and ACP tests. So that's another reason why you shouldn't be discouraged from allowing those employees in. And one of the really big ones that was not part of Secure 2.0, but was just issued guidance this year, is that the audit, the plan audit of your Form 5500 financial statements, is only required if you have more than 120 employees with an account balance on the first day of the plan year. Prior to 2023, you had to look at how many employees were eligible to contribute to the plan, even if they weren't contributing. So this is also very good news, because, you know, if you're close to that number at all, you did not want to let more people contribute to the plan just by making them eligible to. It might have meant you have to have an audit that obviously drives the cost of the plan up significantly. So this is another reason why it's not a negative to allow those participants to contribute. Another thing that is part of Secure 2.0 is that the cash out limit has been increased from $5,000 to $7,000. Why they don't tie this to inflation, I have no idea. So every few years, it seems like they increase that amount. And I definitely recommend clients increase that so that you can also cash out more people and avoid going over that 120 limit and having to have an audit. So what I'm kind of coming to in a lot of cases is, does it make sense to just eliminate all waiting periods for elective deferrals only? There's a lot of logic to doing that, and it would avoid having to track, especially if you have a bunch of part-time employees, having to track their hours. Just say, look, you know, you're basically immediately eligible to make your own deferrals. Doesn't mean we're going to make any employer contribution for you any sooner than we have in the past, but nothing to stop them from making elective deferrals. I think in many cases that's going to make sense. And that another thing that I just like to point out to people is that the state of Michigan, you may have heard about this, but this was a significant change. I was always very jealous of my parents because they would receive their retirement income tax free. They never had to pay tax on their retirement income they received They didn't work for the government, but this was just private employer because they were grandfathered under the rules. I don't even remember when that was changed then. I think it was under Governor Snyder. But the rule was changed so that retirement income was taxed. And now this year, it's just been passed where up to $115,000 a year will be completely exempt from state income tax of retirement income. So we always encourage contributing to retirement plans because there's tax deferral, but this is complete tax avoidance. So just putting it in, you're close to retirement, you just put the money in, you don't pay any tax. If it comes out and you're have less than $115,000 of income, you've avoided tax entirely on those amounts. So it's just another reason to allow more people to contribute to the plans if they can. The other big change that's coming in 2024 is catch-up contributions. They now generally have to be made on a Roth basis if the participant had compensation in the prior year of $145,000 or more. There is an interesting exception in that provision right now for self-employed individuals, because the way they define compensation, they defined it as wages subject to Social Security taxes, basically box 3 on the W-2. So it appears right now that self-employed individuals, no matter how much they earn, if they don't have W-2 wages from the employer greater than $145,000, they could still make theirs pre-tax. I wouldn't rely on that too heavily at this point, because I wouldn't be at all surprised if part of a technical corrections before the end of the year, they bring self-employed individuals into the fold as well. But for now, they are exempt, and it's just anybody that received W-2 wages in box 3 of $145,000 or more. This is going to be challenging. And so there's a couple of things that you really need to do now to prepare for this. Number one, make sure your plan allows Roth contributions. I think most plans we work with do, but some have not implemented that yet. And so by January 1, 2024, you want to have implemented that, and that involves some work with your payroll provider and potentially record keeper. So you want to start that. You obviously want to notify the participants of this change in late 2023. And recognize that if you don't amend the plan or even implement it, even if your plan currently allows it, but you haven't been actually allowing it in practice, you have to allow Roth contributions, or else your individuals who are earning over $145,000 will not be able to make any catch-up contributions. So you can't just allow the Roth for these catch-up. They have to be allowed for all purposes. So you need to make sure that everybody is ready for that change. And one of the unanswered questions is, what happens when you fail the ADP test right now? And a lot of times pre-tax contributions are recharacterized as catch-up contributions. Well, if the individual's earning over $145,000, they would have to be recharacterized as Roth. And it's not clear that that can be done, because the participant made the election for them to be pre-tax at the time they were deferred. So we need some additional guidance on that. And then here's what I talked about previously about the cash out limit increasing from $5,000 to $7,000 as of January 1, 2024. And we definitely recommend that employers consider making that change, especially if they're close to the limit on the number of participants and having to have an audit. Now, the last thing I'm going to cover are the rules that are applicable to governmental employers. There's not a lot. I mean, many of the things in the Secure Act 2.0 will apply to them just like non-governmental employers. One of the big changes is that for governmental 457B plans, they've always had this rule where changes could only be made in elective deferrals as of the first day of a month. Even though 401k and 403B plans clearly don't have that requirement, they can do it, make the changes at any time. So they've now eliminated that, but make sure this is only for governmental 457B plans, not tax exempt tax exempt 457B plans, which still can only have changes made as of the first day of the month. So still have that peculiar little difference, but at least it doesn't apply to governmental 457B plans anymore. There's also an exclusion from gross income for distributions of up to $3,000 for health and long-term care premiums of public safety officers. And that was extended now so that the participants only have to self-certify that the distribution qualifies for the exemption. They don't have to provide other proof. So that's another benefit for those individuals. There's also now an exemption from the 10% penalty tax on early withdrawal for public safety officers who have 25 years of service, no matter what age they are, or at age 50, which had been the rule before. It was extended to correction officers and certain forensic security employees. So that was a good thing. And then one of the big things in that change in Michigan state income tax law was that retirement benefits. So we're not talking about 457 plan deferrals, but retirement benefits of police, firefighters, and correction officers are now completely exempt from Michigan state income tax. And that's effective immediately, which what I talked about, the exemption under for retirement income under Michigan state income tax for everybody, not just police and firefighters, is phased in over the next several years. This provision becomes effective immediately for all of them. So there are obviously many police and firefighters, correction officers who have gone from having their income taxed under state income tax, or at least a portion of it, to now being completely exempt. So that's very beneficial to them. You may want to check if you are paying any of these amounts about withholding and stop withholding Michigan state income tax from these payments, but certainly letting these individuals know that even if there is amounts being withheld, that they will receive those back at the end of the year. That's all I have for today. Obviously, there's not a whole lot of guidance that we've received yet from the government, but there will certainly be more. So look for additional guidance, not only from us, but from the government, and we will certainly update you as we get it and cover everything that's been issued in the November 15th webinar. Thank you very much for your time. Have a great day.